It's Rav, and welcome to the Everyday Investor TV show, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show has been designed to help all of us grow our money. You see, the challenge often is we take our precious time, we go to work, we get a paycheck in order to provide. We take our time, we go to work, we get money in order to eat. And that is a good thing. But imagine a life where money would make you money, so you had more time for the things that mattered most, spending it with family, friends, engaging in a purpose that is greater than yourself. Super excited about today's show. Remember, whenever you're offered any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum investment amount needed? And 4, what is the risk, the worst case scenario? Thanks for tuning in. You don't want to miss this show. We're going to be talking about, wait for it, we'll be right back. Coming up, we're talking to veteran real estate investor Neil Oliver in how to make money in the rent-to-own strategy.
You know, I challenge people to go out into the GTA market and find a property that they're going to be able to rent to a single family and make $1,000 cash flow, right? It's so difficult right now because you've got, you know, these massively high prices of homes. It's hard to rent them to cash flow. So in rent to own, we still are able to do that. We're getting a down payment.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. Before we talk to my good buddy Neil, we're going to find out what's going on in the world of stocks with Omar Khan. Over to you, Omar.
Thanks, Rav. Omar Khan here, guys, with Data Trading. Just want to let you know what's going on in the market. The TSX is doing really well. The S&P 500, largest stock market in the U.S., that's doing pretty well. And the NASDAQ, the tech-heavy index. Now, that's not doing quite as well. Why? Is because of the 10-year treasury yield. Now, that's gone up to 1.7%. Now, what that means is, in simple terms, this. People are investing more in the bond market because they're getting a higher rate of return. They're pulling a lot of that money out of the tech names. Also, a lot of the tech names are having money pulled out of them and into traditional names. You know, your banking, your oil and gas companies, that type of thing. So that's what's happening in the market right now. You're seeing a repricing of assets because of a higher interest rate on the 10-year bond. Now, we're going to keep track of this because the concern is that if it keeps going higher and inflation creeps in, then the central banks around the world, in Canada and the United States, they would have to raise interest rates sooner than anticipated. We don't think that's going to happen, and Jerome Powell in the United States, the Federal Reserve Chairman, said that it hasn't going to happen, but that's what we're going to watch out for. Are interest rates going to go up? Now, for all you real estate investors, that's also going to be important. Anyways, we'll keep a track on that. So far, so good. But in the end of the day, what does power the stock market and stocks in general are quality corporate earnings, and those are still intact. But we will keep an eye on inflation. Back to you, Rav, and we'll see you guys next week.
Thanks, Omar. We'll talk next week. Neil, my buddy, how are you?
I'm great, Rav. How are you doing?
I'm doing great. Thanks so much for being on the show. When it comes to rent-to-own strategies, I would want to talk to no one else other than you and your lovely wife, Rachel. You guys have been doing this for a while now. How long have you been helping people get involved, whether it's the investor, whether it's the tenant who becomes the owner? How long have you been helping these guys?
Yeah, we started doing rent-to-owns back in 2009, so 11 and a half years.
Wow, 11 and a half years. Your success rate is incredible. And, you know, a lot of people, when they think about rent-to-own strategies, first of all, a lot of people don't know what it is. But when they understand it, your name always comes up. And I think there's a component to that is that you really kind of help people, the tenant who wants to become an owner. What I really love about your strategy is you really help them with their credit. Talk a little bit about that.
Yeah, I think when we started to do rent to owns, we quickly learned that, the investors can always win in a rent to own because they own the property. So they're in complete control. So we started looking at it from the other side. What about the tenant buyers who go into these rent to owns, and what is it that we can do to help them actually succeed? So one of the things that we decided to do, and in the last 4 or 5 years, I ended up getting my mortgage license so I could even bring that, the strategy a little bit more oomph, if you want to say, but we started helping them with their credit from about the second month into the rent to own. So right off the bat, we'll lay out the terms of what we think they need to do to improve their credit, and we do usually 3 to a quarter year check-ins with them to make sure that they're actually doing what we ask them to do. And if there are any issues, we immediately try to course correct so that we're not dealing with it in the last 3, 4, or 5 months of the rent to own program.
And, from the investor side of things, the reason why many people like rent to own is because, there's a lot of regulations. I mean, we live in a great country. I would never knock it. I'm grateful to be in Canada, grateful to be in the province of Ontario. But, there's things called the Canadian Securities Commission or the Ontario Securities Commission. And why a lot of people like the rent to own strategy is, we don't have to go through any of those qualifications as an investor. I buy a property legally for somebody who owns it in spirit. And so I'm sure there's a lot of people that like that aspect, that there's not a lot of regulations getting into this investment opportunity from an investor standpoint.
Well, I think what people tend to forget when we talk about rent to own is that really what it is it's a rental with the option to buy it. Right? So for the time that you buy the house, just like you would any rental unit, the difference here is that you actually have somebody who's putting money down. So their stake in the ground is a lot deeper than it would be if they were just renting. First and last is easy to walk away from, but $30,000, $40,000, $50,000, not so much. So, it is really just a rental until they get to the point where they're going to buy the house. So in that regard, absolutely, the boundaries to enter are very, very limited because, it really is no difference than just buying a rental unit.
Okay, so let's walk through that then, because, the returns, I mean, you're averaging returns north of 25% annualized. I mean, that's been your historical average. Walk us through it. So Rav's the investor, and Jimmy is a tenant who wants to own the property. Talk about how it works, because when you just said, Jimmy's going to put down $20,000, $30,000, $40,000, a lot of people, that might throw them off. So explain. We'll after the break, we'll go through a live example. But for now, explain how it works from Rav, the investor standpoint, and Jimmy, the tenant who's going to become the owner.
Yeah, absolutely. So Jimmy, the tenant, goes to the bank, and the bank says, no, we can't qualify you today. You have 5% down, but there's something in your credit potentially. They might be carrying a bit of debt simply because, now things have changed very drastically in the banks, where they look at a car payment and then they look at your income and they create that debt to income ratio. And it's now a little bit, they're not looking at higher debt to income ratios anymore. So in a rent to own, though, that can still work. Right? So this Jimmy goes to the bank, they say no, they come to rent to own, we say yes, because 2, 3, 4 years from now, depending on how we build out that term, they can pay down their debt. They can correct their credit, right? So these are really key elements. And while they're doing all of that, we're building up their down payment from 5% to 8, 9, 10, 11, 12%, depending on where things fit and what they actually will need to qualify. So now they're coming with their 5% down. We send them out with a realtor to look for a property. They pick a property that has to fit the rent-to-own model. So we don't do farms, we don't do hobby farms, we don't do acreage, we don't really do a lot of rural stuff either, because we still have to fit the exit strategies, right? Because even though I think rent-to-own has very little risk, there's still risk. There's risk in anything. So you want to make sure that your exit strategies align with the rent-to-own strategy. So once they've found a house, we then will run all the numbers, we put everything together, we hand it over to Rav, the investor, and we say, here's what it looks like, here's the property. Is this something you're interested in? Now you say, yes, I would really love to make 25% or more, right? That's what we're making when we do rent to owns. And then basically what happens is you buy the house, you're buying it in your name, and the tenant buyer, Jimmy, is actually signing a rent to own agreement and a lease agreement with RAV. So Clover Properties or myself, we sit in the background, we'll manage it all for you, make sure that you're getting paid, make sure that the credit's being improved, make sure they're trending in the right direction. And RAV just gets to, sit back and enjoy collecting the cash flow each month. That's really what it works. That's how it works. But the key to all of that is that Jimmy's putting his 5% down into the deal. So RAV no longer needs 20% to buy the house. He just needs 15%. Right? So you're leveraging their down payment as your own, and it's actually helping to buy that property.
And on top of that, they're paying me some what we call credits, or giving credits each month on top of all the expenses that will go back to them if they end up buying. But if they don't end up buying, then I keep their 5% deposit plus those monthly credits.
Correct. Yeah. So the monthly credits are to help them build up their down payment. Right? Because here's the reality, even at 5% with pretty good credit, I'm not talking perfect credit, the banks may still say no. But they will say yes when you're bringing them a home buyer who has 9, 10, 11, 12%, they have some equity in the property and their credit is over 680, right? So that's the goal of the program.
No, I love it. So basically if I were to go buy a property and then throw something out on Kijiji and I've got to screen the tenants and with it going up, passively with them paying down my mortgage with a few bucks of cash flow, I could make probably 20, 25% annualized. With the rent to own strategy, you guys are vetting who the tenant buyer is. They're putting down 5%. I mean, if it's a $400,000 or $500,000 property, they're giving RAV $20,000, $25,000 up front. Then they're giving me every single month a few $100 on top of all the expenses. I am not going to do any changing of toilets or light bulbs or anything like that. And I know when we're getting out, I'm assuming there's a term here, 2-year term or a 3-year term or a 4-year term. So everybody knows the exact exit strategy. I mean, it's kind of a no-brainer unless somebody wants to buy and hold long term. That might be a different strategy. But if I want to get out in 3-4 years, and with this example, I had to talk to you before the show. I mean, when the producers sent me the sheet and I look at it the morning of today, I had to talk to you before the show and said, is something wrong here, Neil? Because this is not 25 to 30% annualized. You were showing me that there's a real live deal that's, closer to doubling your money every year for 3 years. Why is that? Right now in March, April of 2021.
Yeah. So again, it really comes down to how much is being put down by the tenant buyer, right? Because we get to leverage that, which means our initial investment will be lower. And on top of that, you're dealing with really great interest rates right now. We have investors getting 1.5, 1.6. And when I run those numbers, I'm running them a little bit higher to provide some buffer. Right. So we have to make sure that we have buffer in there for property tax increases, for insurance increases, because who knows what could happen at any particular time. So when the investor turns around and qualifies for their mortgage at 1.6, the numbers start to jump up. Right. So we don't actually need to inflate anything. We don't boost the appreciation by 10, 12%, even though the market might be doing that. We don't need to do that in order to still create amazing opportunities for investors and win-win opportunities for our tenant buyers.
Yeah, no, it's fantastic. Okay, so what we'll do, let's take a quick break. We come back and then we'll go right through the numbers. We're talking to my good friend, Neil Oliver. We're talking about how we can make money in the rent to own strategy. Don't go anywhere. Everyday Investor continues in a moment.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course. or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Rav. Welcome back to Everyday Investor. We're talking to my good friend Neil, learning how we can make money investing in the rent-to-own strategy. Before we go through a real example, let's find out what's happening in the world of mortgages with our mortgage expert, Kyle Ford. Over to you, Kyle.
Thanks, Rav. This week I want to talk about interest rates. They seem to be a hot commodity in the newspaper as well as around the water cooler in the last couple of weeks. Are interest rates going up? Yes, we've seen an increase of the 5-year fixed quite a bit over the last couple of weeks, going from the high ones to the low twos. In the history of interest rates, we're still talking about very low rates, but yes, we've seen an increase. What people aren't talking about is the decrease in the variable rate. So what we're seeing is, though the fixed rate is going up, the variable rate has come down just a little bit with some of our lenders. What that means is an increased spread. So rather than talking about fixed versus variable, what I want to talk about is asset liquidity versus payment stability. Fixed rate gives you a locked-in monthly payment. You know exactly what it will be throughout the duration of your term. However, if you need to sell or refinance, you could be looking at a large penalty. Whereas variable, not only does it give you a lower payment up front, it also is it's a set 3-month penalty. So at any point over the course of your mortgage, if you need to sell or refinance, it's a very manageable penalty. The important thing to remember about a variable rate is that you can also lock in at any time. When it comes to this stuff, always speak to your mortgage broker and make sure you have a good plan about not only your emotional side and how you feel about this, but where you're going to go in the next couple of years. If you ever have any questions, don't hesitate to reach out. Thanks. Back to you, Rav.
Thanks, Kyle. Always great to hear from you. We'll touch base next week. So Neil, we're here learning about the rent-to-own strategy. Basically, Rav, the investor, gets connected with Jimmy, the tenant who wants to become the owner. Neil and Rachel make all of that happen. And so I don't even have to find Jimmy. I don't have to know Jimmy. You give me this deal and you say, hey, Rav, do you want this one or not? If I like it, I go on title. I own it legally. Jimmy owns it in spirit. It may be a 3-year term. I get a big chunk of money from Jimmy. I get credits each month as well that will go back if he completes this. And I think your success rate, I mean, it's close to 90% or over 90%. Correct me if I'm wrong, but over 90% in terms of Jimmy actually buying the property. Now, I don't want people to think that the other 10% or so Rav loses. Unfortunately, if Jimmy doesn't buy the property, Rav still wins, although it would break my heart because I do love the benevolent aspect of how Rav being able to help Jimmy and still make money. So it's a win-win kind of situation. Would I be correct on that, Neil?
Absolutely correct. These deals are all put together with a win-win in mind. But as an investor, there's a few things you have to remember. You don't have maintenance and repairs. So even with 25%, getting 25% in returns like we've been getting in our deals, you still have a higher return because you don't have to worry about maintenance or repairs. They are financially invested as well as emotionally invested because they are selecting the home. This is not a home that our investors are going to be living in. They're not potentially even going to be thinking about living in. They're just going to be buying it for Jimmy to live in. And Jimmy is picking a home that his family loves. So automatically, you've got this real connection to the property. Now they've got money into the deal. Now you've got that financial connection. And as a result, yeah, you are correct. We are 91% success rate. So the 8 or 9% that may not complete in a rent owner usually result of some sort of marriage problem where they might separate or divorce. And unfortunately, that's not an area that I'm very familiar with. I'm anything but a marriage counselor, and Rachel can confirm that. But the one thing we want to do is we still want to create a solution for them. So even where they may want to walk away from the property, we are still trying to find a way for them to finish out and purchase the home where possible. So the goal is always to have our tenant buyers complete and purchase. The investors get to clear out and exit out of their deal in a 2, 3, or 4 year window. And then what we have found is that many of the investors come back for more because they've enjoyed the cash flow. They've enjoyed the turnkey without having to worry about anything, right? That's really what it comes down to. So yeah, you're absolutely right. The success rate is something that we've been targeting and trying to improve on all the way through.
Fantastic. Okay, so take me through a live deal here. Give me one of our recent deals. So where would this be? What area is it located?
Yeah, this is actually a townhouse, a condo town in Hamilton. And, the Hamilton market is crazy, as most people probably know, at this particular time. And the list price on this was $399.
Is that what we bought it for? Is that what Rav bought?
No, Rav buys it for $480. Now, we have comps to prove that $480 is actually a price that is being met in the market. So we work off the comps. Typically, a lot of realtors list low to get multiple offers, and then they want to obviously, increase upon what they would have listed for originally. So we buy this one for $480.
So Rav buys this at $480 for Jimmy and his wife and their kids.
Correct.
Okay, and how long is this deal for?
So this one is a 3-year deal.
3-year deal. Okay, and is that what they typically are?
That would be the average. The thing with the rent to own is that you want to give enough runway for Jimmy to clean up his credit. So it really does depend on what their credit situation looks like. And it's not as much, a lot of people get this misnomer that the credit is a real problem. Like they've missed payments and they're in default and they've got collections. And in some cases, it's just a really big amount of debt because they have a car or 2 cars. So we want to give enough time for them to pay that down to where their income and debt ratios can be more in line with what the banks are looking for. But 3 years would be our average.
Okay, so Neil, what's Rav's down payment and closing costs?
So on 480 purchase, Rav would be putting down $116,000 rounded up as his initial investment. But remember, Jimmy's actually putting $25,000 too, or roughly 5%. So you subtract the $25,000 from the $116,000, and Rav's actually investing just $91,000 in this property.
Okay, so Jimmy is putting down 5%ish, so that's $25,000 that Rav gets, and so what do you say that number is? 91?
91,000.
Okay, so I am in for 91,000. That's my down payment. That's my closing costs, which include land transfer tax, appraiser, I'm sure a fee to Clover Properties. You need to eat, but then he's giving me back 25,000. So Rav's all in for 91K. So now, how do we make money on this?
So there are 2 components in a rent to own. First of all, you have appreciation. So the appreciative value. Remember, this is a deal over 2, 3, or 4 years. And we're not going to sell the house back at the price that we purchased it at because the market is always moving. We have to move with it. So in this case, we would charge appreciative value of roughly $25,000 annually. It's about 5% in and around there. And that would get added to that $480 price.
So 25K, that's how much I'm making?
Approximately 25.
Okay.
And then you have that cash flow component that we talked about, that credit, right? And even though we give back that credit, it still comes to us each month, and that's money that can be used by the investor. So in some cases, the credit could be $300. In some cases, it could be $1,400, depending on the price of the house, the down payment, and the term. In this particular case, the cash flow was $13,000 annually.
13,000. That's a nice number. So 13K
Yeah.
over a grand a month. Okay, so appreciation, cash flow. Any other ways that I'm making money on this?
Well, you're not doing maintenance, so you're keeping the maintenance and repairs in your pocket.
Yeah.
But no, those are the 2 sources. Plus you've got you do have your mortgage pay down. And depending on the length of the term, the mortgage pay down would be roughly $7,000 to $9,000 per year.
7,000 to 9,000. Okay, so mortgage going down, let's call it 8,000. So can you add those numbers up for me? 25, 13, and 8.
Yeah, it's 46,000.
46K. Okay, so is that what you're saying in an roughly annualized that RAV is making, although not liquid, not in my pocket per se, I mean, the cash flow is, but not the mortgage pay down, not the appreciation, that I'm making $46,000?
Not annually, because the mortgage pay down would be over the term. The cash flow, yes. The appreciation, yes. But then we have to factor in, and we have to factor in how we give the money back. So these are not direct numbers. These are sort of gross numbers. And then once we start crediting back, then we get down to more net. And those net numbers are closer to 28,000 per year. So that's what you would net out at.
Okay, because this mortgage pay down, you're saying that 8K, that's over the 3 years.
Correct.
Got it.
It could be a little bit bigger. Like it could be larger. It's just taking an average.
So basically, Neil, what you're saying is 40K, we give back to Jimmy. Rav's left with about 21,000. I put in 91. So when we divide 28,000 into 91,000, that's an annualized return of what? Must be over 30%.
Yeah, 31, 32%.
30. So the ROI, 31% plus, and that is for year one. Then there's year two, year three. It's basically doubling my money in a 3-year period.
Correct.
And this number is net. There's no other expenses because there's no real estate commissions to pay. There's none of that. These are net numbers.
Correct. The only thing to pay would be the legal fees to close the deal at the end, which are already included in that number.
Yes. So that's where, and you helped a friend of mine who works for non-for-profit. He would never, he started an orphanage in Haiti. He would never be an accredited investor. And, I pointed him to you, and you were able to help him. And he's thrilled because, he can qualify for Jimmy's mortgage. And now he's making he's making about 30% plus annualized. And so these are the kinds of people that you can help from an investor standpoint, but then you get to help the Jimmys out there as well.
Correct. And the one other thing, even at 31%, which is what we've been making, you still have a cash flow of about $1,000, right? So, I challenge people to go out into the GTA market and find a property that they're going to be able to rent to a single family and make $1,000 cash flow, right? It's so difficult right now because you've got these massively high prices of homes. It's hard to rent them to cash flow. So in rent to own, we still are able to do that. We're getting a down payment, no maintenance, no repairs, and we're getting cash flow and seeing a nice exit at the end.
No, it's fantastic. I mean, when people ask me, Rav, what's the best investment strategy out there, I always ask them, well, what are you looking for? I mean, I break it down into 2 groups, but really I should be breaking it down into 3 groups, because what I say to them is, do you want to just grow your money and you're not interested in cash flow? Or do you want just cash flow and you're not really interested in growing your money anymore? So if it's to grow your money, I mean, that might, fall into the flip side of things. Or if it's just cash flow, that might be a REIT or a MIC or lending money. But this one is actually both. Do you want to grow your money, and do you want a component that has attractive cash flow? So Neil, this is fantastic. Thank you so much for teaching the viewers. All your information's on there on the screen. But thank you and Rachel for being friends and for teaching us how to make money in the rent-to-own strategy. Really appreciate it.
Yeah, thanks for having me, Rob. It's been amazing. Lots of fun.
Yes, lots of fun. And thank you guys for watching at home. Without you, we would not have a show. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.